Walgreens worked out pretty good. Let's take a look. Hey everybody, this is Pookie's Revenge. We're back with another episode of the 5-year $500 Rags to Riches series, and I look like a hunchback right now because of my hoodie. Let me fix that. All right, let's take a look because Walgreens had their earnings. Let me get the right screen up. Okay, so we've got our Walgreens 0 day that expires today at the end of market, and of course the market's closed tomorrow. So this morning we're up 82% on our contracts that we sold, right? We sold it for 92 cents. We can buy it back now for 17 cents. And then we can open another one. And as long as the price stays below that strike and we don't get assigned, then we keep our shares and can repeat this process over and over and over again. So like Matster yesterday, he locked in a good chunk of those profits and then opened another one today. I'm sure that's probably doing pretty good because of this drastic sell-off we had overnight. And by drastic, I mean it went kind of flat and then it crashed down pretty hard after a little pull-up, and then it's back up, and now it's kind of in a retrace right now. So hopefully his contract's doing okay. Either way, right? There's really no wrong answers here. It's a pretty easy profit for him to scoop up. So I'm going to go ahead and submit a fill order here for, we'll do 18 cents right here just to see. I'm going to try to buy my contract back to close it, right? And just keep the difference. So we'll see if I get filled on that. I might have to adjust it back up to 20 cents. Now the option data on this is a little bit weird. So if I look at the March 28th, so the 0 day here, 2150, it says on the option chain data that it's like 38 to 55 cents. I'm not sure what's up with that. Probably just the IV. Okay, so it looks like we just got filled on the buy order. Okay, so if we look at the orders here, you can see that, let me see if I can just filter this down here. And then we got to click on the contract itself. So, no, it's not going to let me. Okay. All right, I lied. I'm sorry. Sorry. Okay, so if I look at the WBA here, I sold this at 92 cents. Sorry, let me just make a note here. Sold 0.92. Sold has a D in it at the end. Bought at 18 cents. Okay, so if I break out the calculator here, you can see that 92 minus 18 is plus 0.74, which we multiply by 100 is $74 profit. Okay, now that I know that the price is kind of in a retrace, I can either open another contract right here, which I'm going to, or I can sell a contract later if the price goes up higher. Okay, so what I'm going to do is I'm going to roll this out to April 5th. I'm going to start looking at this one to see just what I can get. So in this case, I could do the 2150s and get 70 to 78 cents. So I'm going to go ahead and do that because I know these have higher theta burn than anything farther out. So I'm just going to sell one contract here. And this says 45, 46, 48, so we'll see if we can get a better price on that. I doubt it, but let's also look at other contracts just to see what we can get. So, okay. If the price pushes up here, we should have no problem getting filled at 70. Otherwise, we can look at the April 12th ones, and that's 76 to $1. So I might just roll it out to that one, given the short week. But we'll see. Now this is 15 days out. I really don't want to go that far out, so I might also just reduce the premium on this. Yeah, we'll see. We'll just see what happens in the next couple minutes. Yeah, actually, you know what? We'll just go ahead and modify that. And we're just going to get filled at 47 cents. So let me just do last price here. See if I can get filled on that at 65. I'm probably going to get filled at the 47 cent range. So let me just go ahead and change that. Actually, I'll just do it the price is weird. The new game show. So I'm just going to sell. Sorry. I don't know why. You guys can see this. I just set it to the ask and it says it's 68 cents. But down here it's 43, 45, 47, 46. So let me just try to get filled at 46 on this just so I can open this position. Now in this case, I'm like 1 or 2 cents off. So I'm just going to modify it again down 1 cent. I'm just going to walk it down. It's usually the mid price we get filled at. I'm just going to walk it in here. And in this case, I'm not too worried about trying to get another. Okay, there we go. We got filled. So I'm not worried about getting a $90 fill since this is a short expiration. This is the April 5th. I have the April 12th open down here. So this is an 8-day out expiration. So next Friday. So if we just go ahead and look here. Next Friday, right here is when that contract will expire, and that's okay, right? Because we don't necessarily want the high premium up front. We just want the thing to expire and burn theta efficiently. That's how we make our money. Now, the trade-off, as I discussed in the last video, is that we sell more frequently for smaller premiums, which is great as long as we're not assigned. Once we're assigned, then we have opportunity costs that we lose out on potential profits because we didn't sell the bigger premiums up front before that assignment. So in this case, I'm okay with it because my cost basis is now 74 cents cheaper on these shares. So if I go to WBA, it's 21.26, and if I just break out the calculator again, minus 74 cents. So my cost basis on these shares is $20.52. So let me just draw that line. So my cost basis is down here now. I originally bought them right here, 21.26, so right below this blue line. And the profit just from holding the calls for a week brought my cost basis down here. So that makes it pretty easy. Now this next one that I just sold, I got filled at 44 cents. That brings my cost basis down to 20.08. So if I were to draw a line on that, right, there's that. This is the shift in premium. This is the first covered call. This is the second covered call. So we're sitting pretty right now with a nice low average just over $20. So if I get assigned over 20, sorry guys, if I get assigned over 20.08, I'm in profit no matter what. But if I don't get assigned, I'm still in profit as long as the price is above 20.08. And if the price drops below there, this contract will expire worthless, and then I'll just sell another one and another one and another one. And that's kind of how we walk the cost basis down and get these shares to eventually be free. Because as the price goes up, we can always sell farther out strike prices. So if it goes up to like 21.48, for example, by next Friday, right, we can always look at the 22 or the 22.50s or wherever we think the price might not reach and try to set a call kind of inside that strike price. Now, again, there's no wrong answer. So if I get assigned at a $22 contract, I'm still selling at $22. So still profitable, and I still collect all the premiums on the contracts before then. So I'm okay. So let me just update this here really quick. I know a lot of people are probably following the Walgreens play, mostly because they had earnings, but I'm just going to write down 328 realized, and then the profits here are 92 cents, 0.92, 92, down to 0.18 equals 0.74 equals plus $74. Okay. Now, given that I bought 100 shares, okay, at 21.26, that's $2,126, and I made a $74 profit. Now that's not huge, right? But we're selling weeklies, so it's very frequent and it's very small, but it adds up much more efficiently than the longer stuff. So if I do $74 divided by 21.26 and then multiply that by 100, you can see for the week, right, for the last 3 days basically, I made a 3.48% profit. Okay, and that's it. That's all I need because these are very efficient. Now next week when I get the $44, okay, then that would be 21.26 minus the 74 cents, so that would be 20.52, right? And you can see it's 2.14. So we're getting a little bit of a less efficient fill on this, but it's still more efficient than if I push those contracts out with a longer expiration. So it's always important to keep a log just to kind of sense the efficiency of your contracts. Let me just save that. And then that way you're not necessarily losing out as much, but you can get a head start on which contracts are more or less efficient. Now, let's take a look at NEO, for example. That's the one up here on the top. I'm just going to kick this up to the 30-minute, and you can see we're recovering nicely. We got a little inverted head and shoulders here. We held support. We got pushed back up. If it goes up, great. If it goes down, great. If it goes sideways, great. We don't really care, right? Now, I know that I'm still in or around roughly profitable territory, even though the price is sold off, and this is kind of what we rely on for covered calls. We want the price to go down or sideways or even up, but we don't want it to exceed the amount of effectiveness we have over our cost basis. And that's kind of where you want to keep track of your stuff. So if I look at NEO here, you can see I realized this 21 cent profit, and then I have another 30 cent profit on top of that. So if I take my average of 535, subtract 21 cents, that's 504. I'm sorry, 514. And then I subtract 30 from that, you can see we're a little bit in the red. So we're down at like 485-ish, or 482. but we're just below that. So I'm not too worried about that as far as, realized profit if I sell everything. All right, and then if we look at Plug is another one. It's just going sideways. I love it. It's a beautiful one, and I'm going to probably make this one a little bit bigger, but I wanted to talk about cash secured puts for this particular episode because this is the one, we're going to build into the wheel, okay? So buying the shares is very easy. You just hit buy and you change your quantity to 100. But with cash secured puts, there's a way to get paid to place that buy order, which is pretty cool. And the way that we can do that is a cash secured put. So I got to do this very quickly. I'll elaborate and make another episode tomorrow that describes it in more detail. But there's a reason I'm walking you guys through these progressions, and that's so that you guys can build in into your own particular approach. So if you don't like covered calls and you don't like cash secured puts, the dividends and the investment stuff that we covered in the earlier episodes is still growing in the background. So if I go over here, for example, and I switch to the original $500 account that I don't really have to manage now, it's just growing, right? 33.24. It was at 32 something. Before that, it was like 29 something. It's just growing and growing and growing, and we still have another contribution on Monday that I get to make that will increase this up to 3,800. So if we look at the positions here, I still have my OCGN, and this one is in profit. It's above the cap, so I could lock this in right now, or I could wait for this contract to deflate some more, given that it's an April 19th contract. So in this case, I am now above the profit cap, and I haven't had to do anything other than just let it breathe. Okay, so what happened? Price surged. Okay, price surged, and that increased the share value as well as the value of these premiums on these calls that we sold, which decreases my profitability. But now the price is going sideways, and these calls are deflating, right? Because theta is wearing them down, the IV is falling off, and the price is just going sideways. Which means every day, more and more of this value is chipped off. It's brought down closer and closer and closer to zero as the days go by, which means that this number here that's being subtracted from this number is smaller and smaller, which makes this number bigger. So my original profit cap was $29. It's currently above that at $31.50. So this is all I'm waiting for. I'm just letting it breathe. I'm letting it do its thing. And then before assignment or before expiration, I can always buy this contract back at a cheaper price, because by then it'll be down below 25, unless I get assigned, in which case I'll just lose the shares or I'll sell them at $1. But the lower this goes, the more profitable this becomes, and then I can just buy the callback, close it, and I'll keep my shares, and I can still sell those shares at 80% profit if the price goes flat the whole time. Either way, we're well above where I bought them at 96 cents. So it's profit, profit, profit. And we can break that $29 profit. So with cash secured puts, we can effectively add another step in here. So rather than me having bought these shares at 96 cents and then selling one covered call against them, I could have sold a cash secured put, which is basically the same thing but backwards. It's just used to acquire shares. And again, I'll go into more detail next episode. But we can sell a contract that if we get assigned, we have to buy 100 shares at a specific strike price. So it's pretty cool in that it automatically gives you a discount on your cost basis. So if you sold a cash secured put to buy 100 shares at $5 per share, and you were paid 50 cents to place that order, right? If you sold the contract and were paid 50 cents premium for that put, your cost basis is already down to $4.50. And that's pretty cool, because if you sell a $5.50 call against that for your shares that you've got at $5 minus the 50 cent you collected on premium, but if you sell a call for another 50 cent premium, your cost basis is then down to $4. So all in the same day. It's pretty cool how that works, as long as you get assigned, obviously, on the cash secured. But if you don't get assigned, you could just rinse and repeat it, and that's what one of our team members is doing. He's just selling cash secured puts and hasn't been assigned much. And when he does, he's just going to start rinsing those calls. So again, if this particular piece of it doesn't appeal to you, or if maybe you don't have enough capital to do that, the lower tier, the lower step in the hierarchy is just to build your portfolio through savings, passive income, investment, dividends, stuff like that. So if you're not up to this level, it's okay, right? You don't need to take risks to get there. You just got to be patient and keep making your contributions matter and letting those dividends just roll in and kind of do their work. So I don't want anyone to feel like they have to, catch up or feel left out because they don't have enough capital. this demonstration with the covered calls and stuff is mostly just for people who do have capital, just so that we don't have to wait too long to learn this stuff. So as far as the investments and stuff go, these are still trucking along. Neo calls up a little bit from yesterday, but again, that's a many month hold. So I'm not freaking out over that. And then of course the OCGN is above the profit cap. Main is up. Ladder's still, this one's just always hanging around my average, which is okay. Schwab, JAPQ, and Johnson & Johnson are all up. Tesla obviously is down a little bit, and Clip is down a little bit. So that's been that way for a very long time, for a couple of months, and that's kind of exactly the way we want it, right? So that's it. Let me just kick over to the other account really quick, and then Monday we're going to make our other contribution, and then I will walk through the shares that I'm going to buy and the reasons why, and we're going to work through the diversification by yield, and we're going to start working up into the same approach that we've been taking this whole time since last September. So thank you all for watching, and tomorrow the market is closed, so be careful if you have any contracts expiring today. I will be closing this SPCE contract next week, not today. Walgreens is good for next week. Again, you can see I sold this at 44 and it's already down to 29 cents. We sold it at an inflated premium because the price was surging and then it was falling back down. So as the price falls down, these contracts will fall down. So I might be able to lock this one in even earlier, but we'll see. I'll let it go. The goal is 70 to 90%, in my opinion here. So plug. This is also next Friday, so I don't have any contracts left that are going to be expiring today. They're all next Friday or after. So my work here is done as far as the week goes. And if I look at my account here, you can see, not a huge amount of P&L here, but we are amassing equity and we're reducing cost basis, and we're just letting the process work. So it's pretty good. And the only thing that's really holding us down right now is Neo. So if we took this this red number here, sorry guys, I don't know what's wrong with me. If we took this red number here and we removed it and added it to this value, that's where we'd be at. So that's where I intend to be at once this call, once the set of calls expires. Now it's a little bit farther out, so it takes a little bit, but once that expires, that number 84 times 30 will be added in its entirety to this value, unless I buy it back early like I did with the first round of contracts on Neo, which is probably what I'll do. This was at 80% profit, I think it was this morning. So I'm going to just kind of keep an eye on it. And once it hits that 75, 80% range, I'll probably lock it in, sell the next one. And I'll probably go a little bit shorter on the next one just so it can kind of be in the same vein as this stuff, but we'll see. All right, I will end this episode here. I appreciate you all watching. And again, be safe and enjoy your holiday weekend, and we'll see you guys next week.